Coming up on Market to Market. Fire, flood, and drought continue to plague the West. The Secretary makes the administration's case for a farm bill. And USDA finds even more corn and fewer soybeans. Those stories and market analysis with Alan Brugler next.
This is the Friday, September 13 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. U.S. consumers were more reluctant to open their wallets last month, prompting economists to speculate the economic road ahead is going to be bumpy. According to the Commerce Department, spending at retail businesses rose just 0.2% last month, the smallest gain in 4 months. Excluding the more volatile sectors of autos, gasoline, and building supplies, retail sales in August increased just 0.1%. Labor Department figures show the Producer Price Index increased 0.3% last month after being flat in July. When food and energy are removed, the so-called core PPI remained unchanged. And as the U.S. and Russia hold discussions in Geneva aimed at getting Syria to give up its chemical weapons, the price of oil moved lower after closing at a 2-year high late last week. As the last throes of summer approach, a few fields at lower elevations are starting to reflect the coming change of seasons in the Midwest. Some of those crops have been pushed farther along by the lack of available moisture. Those dry conditions continue to persist farther west, where wildfires have been blazing across thousands of acres for nearly a month. And after soils are exposed to temperatures exceeding 1,500 degrees, the environmental impact goes beyond the visible scar of a blackened wasteland. The Wild West lived up to its name this week thanks to continued drought. Fires in California burned for the 4th consecutive week as crews tried to contain the 3rd largest wildfire in state history and deal with new blazes. The Clover Fire in Shasta County has destroyed almost 70 homes. This blaze began Monday in Happy Valley, 150 miles north of Sacramento. The inferno moved at a brisk pace, consuming 500 acres per hour. The Mount Diablo fire northeast of San Francisco was another fast-moving event, and residents were given just a few minutes' notice to evacuate their homes.
Ran out, started to pack up our stuff and get ready to evacuate, and by about 4 or 5 p.m., the whole mountain was just engulfed, and there's just flames shooting up the mountain.
And the infamous Rim Fire that started August 17th near Yosemite has burned nearly 400 square miles. Containment is expected late next week. Even as crews try to contain the massive fire, 50 scientists are working to identify areas of highest risk for erosion into waterways in areas charred by the blaze. Habitat burned in a wildfire is stripped of water and soil retention abilities and often takes several years of ideal growing conditions to regain its environmental benefit. For the past few summers, large wildfires have burned through several regions of Colorado. This week, heavy rains flooded some of the same areas, prompting officials to call it an extremely dangerous and life-threatening situation.
This is completely different from the fires, and yet preparation is trying to anticipate what you really don't expect. And we have been trying to train across the state for unexpected eventualities, things that we would never expect to happen. I'm not sure anyone laid out a scenario where Boulder County, in every single canyon from Coal Creek right up to St. Vrain got, close to 8 inches of rain in a 24-hour period.
Boulder County was hit the hardest, with up to 6 inches of rain falling over 12 hours. Flooding was reported from Colorado Springs to north of Fort Collins. The flash floods killed at least 3 people, stranded motorists, and made several roads impassable. The National Weather Service says a 20-foot wall of water was reported in Left Hand Canyon near Boulder.
I've never seen it like this. We sort of roll our eyes when they say, you got to be prepared for the 100-year flood, but here we are.
Usually Left Hand Creek is just a trickle. They turn it off and on. You can wade across it, have fun in it. And now, as you can see, it's hitting houses. It's knocked down a back fence. It's knocked out a door off the back of a house already. It's really, one of our neighbors said you don't see stuff like this, but maybe every 25 years.
It's unclear at this point if current rains will help lift that region out of drought. as much of the western United States is locked in that condition. Over the past few weeks, though, easing of the arid situation has occurred in portions of Kansas and Nebraska. Other portions of the Corn Belt have not been as fortunate. This week's drought monitor from the University of Nebraska reveals arid conditions in parts of Minnesota, Iowa, Wisconsin, Missouri, and Illinois. And just over 50% of the contiguous U.S. is locked in drought. While some rain did fall over the Great Lakes region this week, much of rural America was hot again, with temperatures pushing over 100 degrees, shattering long-standing records. The flash drought impacted several rivers, streams, and farm fields. For example, in La Crosse, Wisconsin, only 2.4 inches of rain has fallen from July 1st through September 10th, breaking a record set back in 1948. But prior to the last 3 weeks of hot weather this summer, on average has been cooler than normal. Nevertheless, USDA meteorologist Brad Rippey says America could be in for a warm autumn.
I really don't think normal is in our vocabulary for this fall after what's happened this summer. There's going to be, I think, more weather extremes, including the hot weather we've been seeing, a warm autumn on tap for parts of the country, most likely across the northern plains and parts of the interior northwest. I think we can expect to see some pretty chilly conditions from time to time, particularly in the northeastern United States.
Currently, 54% of America's corn crop is pegged in good to excellent condition. But Rippey says the late maturing crop could benefit from a warmer fall.
As we head at least to mid-September, there is no sign of any freeze in the near future. The normal first freeze dates in the far upper Midwest, typically late September, and in the far southeastern Corn Belt and the vicinity of the Ohio Valley, normal freeze dates are mid-October. So at this point, there's nothing to indicate that we'd have a spectacularly early freeze that could cause harm to crops.
Congress returned from its latest vacation this week, only to face such thorny issues as a proposed military strike on Syria, the need to raise America's debt ceiling, and attempts to repeal Obamacare. Further down the priority list lays the Farm Bill, a languishing 5-year comprehensive measure authorizing federal spending on everything from nutrition programs to disaster payments for farmers. But lawmakers only carved out a handful of days to reach a compromise before an extension to the current 2008 Farm Bill expires on September 30th. And this week, the Obama administration's point man on agriculture called on Congress to act. Speaking before National Farmers Union leadership in Washington, D.C. this week, Secretary of Agriculture Tom Vilsack emphasized the importance of congressional action to prevent further extensions to the 2008 Farm Bill.
You do have to begin questioning whether or not this is really a priority, and it ought to be a priority. Because it's not just important to rural America, it's important to all America.
Lawmakers in the House of Representatives could debate cuts to the nutrition assistance aspects of the Farm Bill as early as next week. Hoping to cut $40 billion from nutrition programs over the next decade, GOP leaders are proposing 10 times the reduction found in the Senate version of the bill. But the move to make such deep cuts in things like the Supplemental Nutrition Assistance Program, formerly known as food stamps, could make it impossible for Congress to reach a compromise. And Vilsack says another extension will leave producers unsure of how they should be conducting the business of farming.
It doesn't provide the certainty that producers need to be able to make decisions and plans about expansion, about continued operation, about transfers and transitions to the next generation. You can't do any of that unless you know what the programs are going to be.
About 2/3 of the federal spending authorized by the Farm Bill goes towards nutrition programs, while less than 3% is earmarked for other programs, including research. Vilsack cautioned that the lack of congressional action could have a negative impact on America's colleges and universities.
And all those great universities that we like to brag about, honestly, I'm more concerned now about the researchers than I am the football team. And everybody in America should be as well. You cannot invest. You can't have top-notch researchers unless you invest in those researchers.
Vilsack says he has very, very strong objections to another extension of the current Farm Bill, and he characterized an extension as a reward for continued failure.
Next, the Market to Market Report.
Last season, it quickly became clear the worst drought in 5 decades was going to cut yields dramatically. This season, hope for a bin-busting crop persisted despite cool temperatures and a freak May snowstorm in the Corn Belt. The recent flash drought hitting the Midwest has fueled dire predictions of lighter-weight corn kernels and unfilled soybean pods. All farmers could do was wait and see. This week, in a series of monthly reports, the USDA pulled back the curtain just enough for everyone to get a closer look. Despite persistent drought in many parts of the Corn Belt, government analysts actually increased estimates on 2013 corn production. According to the Agriculture Department, U.S. producers will harvest a record 13.84 billion bushels this fall. That's up 80 million bushels from the August report. USDA pegs the national average corn yield at 155.3 bushels per acre, up more than 25% from last year's drought-reduced crop. Government bean counters, however, say there are fewer soybeans in America's fields than previously believed. USDA is now calling for total U.S. production of 3.15 billion bushels, down 3% from last month's estimate. The national average soybean yield is expected to decline to 41.2 bushels per acre, reflecting a 1.4 bushel reduction from last month. Since the Agriculture Department will release its small grain summary at the end of the month, government analysts made few changes to their August estimates on wheat. Total U.S. wheat production is estimated at 2.11 billion bushels on a national average of 46.2 bushels per acre, virtually unchanged from July's predictions. Turning to its monthly supply and demand estimates, USDA lowered its domestic old crop corn ending stocks by 8%. But the government predicts record production will result in new crop ending stocks of 1.86 billion bushels. Analyzed as a percentage of demand, the numbers add up to an ample domestic stocks-to-use ratio of 14.6%. If realized, that would be the highest corn stocks-to-use ratio in 8 years. However, strong demand is expected to support prices. And despite record anticipated production, USDA analysts reduced their season average price estimates by only a dime from last month to $4.80 per bushel. U.S. soybean ending stocks are predicted to fall more than 25% from last year to 125 million bushels. An accompanying domestic soybean stocks-to-use ratio of 4.8% is tight by historical standards and leaves little room for production shortfalls. After factoring strong anticipated global demand, the Agriculture Department increased its average price estimates by more than $1 from last month to $12.50 per bushel. And the U.S. wheat stocks-to-use ratio is predicted to decline to 23%. While that would be the tightest supply in 5 years, it's easily enough to meet domestic demand. And after considering estimates of increased global wheat production, the figures prompted USDA to lower the season average price estimate by a dime to $7 even per bushel. USDA's supply and demand reports had bearish implications for coarse grains, but the bulls came charging through the soybean pits. For the week, December wheat lost 6 cents, while the nearby corn contract moved a dime lower. Soybeans rallied strongly on the report as the November contract settled Friday with a weekly gain of 14 cents. Nearby meal prices followed suit with a gain of $13.85 per ton. In the softs, the December cotton contract rallied $1.25 per hundredweight. In the dairy market, October Class 3 milk rose 26 cents, while the November contract gained 32 cents. Over in livestock, October cattle fell 42 cents. Nearby feeders gained $1.25, and the October lean hog contract posted a weekly loss of 20 cents. In the financials, the euro gained 124 basis points against the dollar. Crude oil lost $2.32 per barrel. COMEX gold lost more than $75 per ounce, and the Goldman Sachs Commodity Index lost more than 9 points to settle at 651.55. Here now to lend us his insight on these and other trends is one of our regular market analysts, Alan Brugler. Alan, welcome back.
Always good to be back.
Alan, we did have a bit of a run-up in the stock market this week. What's driving that?
Well, I think part of it's just that all the traders were on vacation in August, came back to work. You had some IRA money and some 401k money to put into the market, and some positive feelings about the economic growth overall. So The key point, I think, is you're getting a little asset allocation shifting here. There was a big rush towards bonds. There's still, out of bonds. There's still money leaving bonds, but people are saying, well, with a 4% yield, maybe I ought to put a little back that way. You're shifting the mix of stocks that you're buying.
And the shift is coming, it's not being reallocated towards commodities. We're not seeing a compelling story in any of the commodities?
That'd be a little bit of a stretch, but there's a lot of commodities that we're seeing net outflows yet. You saw some money coming into the soybean pit, the soybean complex, actually. Obviously, hogs are still fairly high, but yeah, there's others like the feed grains that have been under pressure, and they're just not getting any money flows.
Well, let's talk about wheat as an example. We didn't see any change in the wheat in the USDA's WASDE report came out Thursday. Is the market expecting to see a change in numbers here at the end of the month?
Well, we are looking for that small grains report on the 30th and the grain stocks report on the 30th. I think the grain stocks report for wheat is going to be fairly positive. It's going to show probably September 1 stocks below 2 billion bushels. We've had phenomenal first quarter exports for wheat and also pretty strong feed use because of the lack of corn. So we've drawn down that wheat supply pretty nicely. USDA, as you mentioned, didn't make any adjustments on the wheat production because they've got a full report coming out in a couple of weeks here for it. But the story in wheat is it's tied to corn. You're dependent on the feeding to keep the balance sheet tight on wheat. And if wheat prices go up, then you don't feed the wheat, then you've got too much wheat, and the price has to come back down. So they're kind of married until corn bottoms out, gets some kind of a harvest low established. Wheat will be slow to go up.
Okay. All right. So not looking for anything bullish here, at least through the 30th.
There's a little tendency for it to go up from the end of September into November, but that's, again, we're not there yet.
Okay. Now let's talk corn a little bit. When are we going to touch that bottom? We did have the report come out, raised production in corn. What are your thoughts? Is the market trading that 155 number?
I think we're adjusting to that number. We were convinced that it was a little lower. You know, we'd had that couple of week rally there out of the August crop report. And now we're getting a continuous diet of pretty high yields out of the southern parts of the Corn Belt that are really fully into it. And even some of the test cuttings further north are better than expected. So, yeah, we've got to adjust to a little higher production. Frankly, the problem is that even if you lose 2 or 3 bushels off of the USDA number, you're still going to have 1.5 billion bushel carryout. So with this many acres planted, there's just too much supply no matter how you slice it.
And that being said, looking at the export reductions through 2012 into 2013, is there hope that we can gain back that export market going in 13-14?
I think we're going to pick up some. We've actually got a multi-year high for export commitments coming into the start of the marketing year. All right, best in at least 5 years, and actually I think it's a lot longer than that. So lower prices do attract some of that business back. Now, that said, some of our traditional customers are buying feed wheat, or they're buying Ukrainian corn or some other source. We're going to have to get the price down to convince them to come back to the U.S. market.
All right. Now, all of that being said, looking at the price just shy of $4.60 on Dees corn, what are your thoughts? What sort of target ranges do you have out there?
Well, we know that the swing low there in August was $4.45 area. On the longer term charts, the weekly and monthly charts, there's pretty good support at $4.35 and at $4.16. And we're really thinking one of those is going to hold here. Maybe the $4.45 will hold, but it's a little soon to tell. Again, the big problem is just we know it's a big crop, plus or minus a couple 100 million bushels. The wild card's probably the planted acreage. USDA didn't do anything with that this report, weren't expected to. Mm-hmm. The FSA will come out with updated farm program numbers on the 17th of September, and then USDA will incorporate them into their data set for the October report. So we're fairly sure we're going to lose some planted acres by the time we get to October. And if you were, just hypothetically, to take 2 million acres off, that would be 300-some million bushels. And it does change the equation a little bit.
So best chance for a rally, looking at the way things stand now, would be around that October report, most likely.
Yeah, there's always potential with that grain stocks report on the 30th, but the new crop number would be the October crop report.
All right, well, let's take a look at soybeans. Did get some bearish news yesterday. We did see yields reduced about 3%. Is that where the market, it was right on market expectations, that 41.2 number, but we did see a pretty nice rally. Gave some of it back on Friday. Where do you think it's going to head next week?
Well, I was impressed with the amount of buying interest on Thursday. The market basically didn't get anything it didn't already know. As you mentioned, we were trading at the trade average guess for yield. The market tried to break early in the report day session, and then saw pretty strong buying, up 35 cents or more in the November contract. A lot of that was tied to soybean meal, which was limit up on Thursday. We're having trouble early in the marketing year making enough meal to meet the export commitments and domestic demand that we've already got. So meal's kind of the key to that strength. November beans have had trouble every time we've gotten above $14 though, including today. So I think that's kind of the key marker, 14 to 14.10. You take that out, then the bulls will start running again, and the specs will probably throw a little bit more money at it. But you've got to have meal go another leg higher to support that.
And so it's going to be meal that's going to get beans over that $14. Is there anything else that could, news event, headline, that could drive us over 14?
Well, I think we were getting a little more comfortable with rain in the forecast for the next week in most of the Corn Belt, thinking that maybe we'd slow the deterioration of the crop. There's definitely later beans that would still benefit from a 1-inch rain. So the bullish input there would be if the rains are less than expected, or you get some more harvest results that show that we did have a lot of pod abortion due to the temperatures and weather in August.
And we'll just have to wait for the combines to roll to see what we're really looking at in those numbers. Now let's take a look at cotton. We've been on a roller coaster ride this summer with cotton prices. We've been steady the last week or two. Now we saw a little bit of an uptick. What was driving that move in cotton?
Well, cotton is kind of difficult to discern here because globally we've got record stocks. 316 days of use if you just didn't grow anything. That's over 9 months where you wouldn't need any cotton at all other than what's already in the warehouse. From that standpoint, prices ought to be a lot lower. But the reality is a lot of that cotton's tied up in China. It's not leaving China. If they free up the reserves, it would mainly affect the import program there. Okay, U.S. would lose exports if the Chinese start to work down their stocks. But yeah, basically USDA made minor changes to their export forecast and to their ending stocks forecast. There's a little money flow there. As the world economies are picking up, that you do see some additional demand for cotton goods.
Okay, so it's going to be China longer term as the price mover on cotton.
Right.
Now moving over to cattle, as we take a look at livestock, we have seen a lot of support here around that $125 level. Cash cattle staying pretty steady. What are your thoughts as we roll into September? Kids get back to school, and where are cattle headed?
Well, we've got a couple cross currents going there. The wholesale price has been under a little bit of pressure. That's not unusual right after you go back to school. The finished numbers, the numbers of cattle coming out of the feedlots, will be declining from here until November. That's a supportive factor. It gives the feedlots a little bit more leverage. We've had excellent export sales, the second largest month in history in July, according to the recent census release. And the weekly sales numbers suggest pretty good movement. So we think the market will be well supported here from the product side, and the declining numbers will be supportive as well. So futures in the 125 area makes sense right now, probably later on 127, 130. The biggest problem, frankly, for beef and for pork as well is a rapid expansion in chicken production.
Meeting the lower cost protein needs.
Yeah,
some substitution.
The egg sets and the broiler placements have been running 3 to 5% over a year ago each week. Over the corresponding week. So it takes a little while to feed those birds out, but you're going to have additional poultry competition, and it's typically cheaper than pork or beef. If the consumer goes that way, the demand side is a little iffier than what we've seen in the last year or two.
Okay, so keep an eye out on consumers maybe with some sticker shock at the meat counter. Now taking a look at feeders, where do you see us headed in that market?
Well, if corn hasn't going down yet, hasn't finished that decline, then feeders probably have a little upside. Basically, there's a trade-off there. If we assume the cattle market's steady to higher and corn gets a little cheaper or meal starts to pull back, then you'll tend to see that bid into the feeders. So the weekly chart says nearby feeders can go back to $161, $161.5. That would be higher than we are today.
And that would be close to a high for the year.
Yeah, actually, 161.50 would be the record high for nearby futures. So that, and of course, numbers are down. We're at a 50-year low in the herd size and the calf crop and so forth. So as long as it works into the feeding equation, and the cattle crush spreads are all positive for the rest of this 2013, there should be demand for those feeders.
All right. Now, as we take a look at pork, as you mentioned, increased poultry production, where does that leave the pork market here in the short term?
Well, we're trying to expand pork production. The sow numbers suggest that. We'll find out about gilt retention here with the hogs and pigs report. Quarterly hogs and pigs report comes out before the end of the month here. The complicating factor is the PED virus. We've had pigs on the ground that may not still be there because of the disease issue. So that affects what your hog marketings are for the fourth quarter. If it turns out we did have more extreme problems, then that's supportive to the pork price. Cash hogs normally do come down into October, November from where they are in the summertime, and that's happening. But the degree of the decline will be affected by the numbers that actually make it to market.
And consumer demand for pork products, particularly bacon, we know was driving the market over the summer. Is that predicted to continue?
Well, bacon typically slows down. The price of the bacon component, the pork belly component, goes down as we get into fall. Normally, if you're going to have further strength in the cutout, it's because the hams or some other component picks up the slack.
We get into holiday season.
Right.
Thank you so much, Alan. Appreciate you being with us today.
You're welcome.
That wraps up this edition of Market to Market. But Alan and I will continue our discussion and answer some of your questions in our Market Plus segment on our website. You'll also find audio podcasts and streaming video of our program, as well as links to our Twitter feed and Facebook account exclusively at the Market to Market website. Be sure to join us again next week when we'll learn how a full-time grain farmer is testing the waters of aquaponics. Until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content.